Welcome back to the program. Grant Patterson from Providence Wealth is standing by via Skype. Grant, I'd love to go and get your views about what we've seen recently. I was just having a chat with a previous guest on the program, and he said it had a little bit of an echo to 2008 about it. What's your sense?
Well, it's certainly volatile. It's been incredible, the moves on a day-to-day basis. I mean, if you have a look at that 2-year Treasury move from a bit over 5%, which looked very attractive, then all the way down to 3.8, and then back to 4.24. So you've had 130 basis points of swing in the so-called risk-free rate over a period of 36 hours. So it really has been a flight to quality at the front end. Markets, quite rightly, are spooked by what's been going on in the banking sector, and I note that it was really at the epicenter of the crypto world, and so that's really unnerved markets, and so the comparison back to 2007-8 with the Lehman sort of thing is not surprising. I don't believe that is the case this time around. I think the banks are in much better shape, but they're sitting on enormous mark-to-market losses on their bond portfolio. I think the US banks are probably sitting on around about $700 billion of unrealised losses in government bonds because of the very sharp, very quick move in interest rates this year.
So moving forward, how does this likely to go and play out? Because what we've seen in the past is that the Fed tightens and eventually something goes and breaks, usually in the financial system. Is this time going to be any different in your opinion?
Oh, look, I don't think we know where all the sort of the hidden dangers are. As I said, you can't have this sort of volatility and this quicker move in interest rates without some impact in unknown areas, and we saw that with the Silicon Bank. It's just extraordinary how quick these moves are. And remember, we've come out of a period of where cost of capital was zero. It was free money, and investor behaviour was indiscriminate. Well, now there is a cost of capital. There is now an alternative for your investments, which is cash, and therefore, I think we've still got a fair way to go through this. My caution over the last year in our discussions. We're still maintaining the very diversified stance for clients' portfolios. We still hold our gold in Australian dollar terms, which has performed quite well, and we've got an elevated level of cash. So we're still cautious and defensive. However, I'm getting pretty excited that there's going to be some pretty good opportunities coming up as this year progresses because of the distress that we'll see in various pockets.
Grant, let's go and talk about some of those areas that you potentially might go and see that stress. And you mentioned the impact that higher risk-free rates have had on bond valuations. What about the bond proxy sectors out there at the moment? How do they stack up? Because we haven't seen any real valuation effect in a lot of those areas, despite what's going on with interest rates.
Well, there is this big disconnect in the direct private markets. There hasn't been the adjustment you quite rightly point out in their valuations, despite a huge increase in the risk-free rate. So we've still got to see that unwind in our view. The listed markets are telling you a different story than the direct markets, and that's particularly evident in the property space. The A-REITs have had a big fall, bit of a good bounce now, but are still down quite substantially, yet the direct property market is in a bit of a standoff. There is, from what we understand, a huge amount of property on the market in the commercial space, and there's a big gap between the vendors and the purchasers, and we're waiting to see who blinks first to reprice those assets to what the current cap rates are in the listed market. So, okay. I'd be watching for that.
Okay, we'll keep a close eye on that. That's one area to go shopping potentially in the latter part of this year. Any other sectors or names that you can go and point to as where you think that some opportunities will start to go and come up as a result of higher costs of capital?
Yeah, I think the distressed credit area is going to be quite interesting. We're going to see, and we're starting to see defaults already, and that's normal part of the cycle. As interest rates are rising quite sharply, the economies are going to slow. There's going to be a bit of pressure out there, which we're already seeing. So I'd be keeping an eye out for distressed credit. There's some very good managers who manage distressed credit globally. You'll be able to buy some of that credit at substantial discounts to the face value, and they'll work their way through that. So that is an area that we're very keen on. Within equities, we think the Australian market looks pretty expensive relative to the rest of the globe, particularly in the banks. So we're cautious there. And around the regions, we quite like the Japanese equities. There's a real change going on in Japan of activist investment, and that's unlocking quite a lot of capital from the banks. So that is a region that we quite like. But we'd still be relatively cautious. We still think we've got a fair way to unwind the euphoria of the last couple of years. And we're not convinced that the Fed or the Reserve Bank are likely to cut interest rates in a hurry, because inflation, we believe, will be quite sticky. So we might see a pause, but we're not of the view that we're going to see a big decline in interest rates from these levels, unless we go through a deflationary bust, which is possible, but we'll have to wait and see. So it's still pretty diversified, a reasonable level of cash, and being very disciplined and patient from our stance.
Grant, just to go now and finish off, when it comes to the central bank, you just mentioned that you expect there's not going to be any widespread cuts coming through unless there is some deflationary spiral that starts to go and form. How much further do you think we've got to go in this tightening cycle at the moment, given we're already seeing some stresses start to come across in more speculative assets such as crypto, such as, I know, some of those crypto-linked banks and startup-linked banks that we're talking about the past week or so?
Well, David, I don't know, and I don't know that anyone does, so I'm not going to pretend to be able to predict that. My gut feel and my experience would say that, this week has rattled markets and would have rattled the Fed. We've seen the regulators come in and to support the banking system. That's quite significant and quite serious. So I think there'll be a lot of dialogue going on at the moment between the regulators, the Fed and the government about just letting things steady. So I'd be surprised to see aggressive rate rises from here. I think we'll more than likely see a bit of a pause and let the dust settle and see how it pans out. So, once again, although I don't think that we're there yet, I still think that there's some stresses in the system that's got to wind its way out. As I said before, I am getting excited that there will be some opportunities if you've got liquidity, if you've got cash coming up over the next 6 months, and we're poised, if you like, to take advantage of that. As you know, we've been pretty careful and cautious over the year. We've built up our cash. We haven't sort of chased the speculative end, and that's going to be quite exciting for us over the next 6 to 12 months as things unwind.